Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. And this week's topic, guys, is on trade management. How you can win more often with your trades by using half the shares, double the stop. It's a very powerful technique, especially for newer traders, people who are in their first 3, 6, 9, 12 months of trading. It certainly can be helpful for experienced traders as well, but it's a very powerful technique, especially for newer trades. How you can win more often with your trades, because let's be honest, newer traders get things wrong. That's normal. You don't know exactly what you're doing. You're still learning, etc. and so forth. Even though you might have a pre-trade checklist, you're not exactly clear about that. You're still trying to match those pictures together, and we make mistakes. By using half the shares and double the stop, you give yourself more flexibility. And in doing so, you won't stop out as often because, let's be honest, there is nothing more frustrating in trading than to stop out by 2 pennies, 3 pennies, 4 pennies, and watch the stock pivot and go higher for the rest of the day, and you're like, damn it, I picked the right stock, but I didn't make money. And not only did I not make money from it, I lost money on it. And it's extremely frustrating. And again, it happens more frequently to newer traders because they're still honing their skills. They're not exactly understanding what they need to do specifically. They're, again, still learning. That's normal. So by giving yourselves more room on the stop loss and taking half the shares, there are a lot of benefits to it and very, very few negatives. Okay, so today's topic, guys, is half the shares, double the stop, how to win more often with your trading. And I think it's going to be a big deal for you newer traders out there because I'm getting a lot of comments from people saying, you know, Jared, how do I keep from getting stopped out so much? Well, this is the perfect way to do that. I want to apologize, guys, real quick. Last week, I didn't get a chance to do a lecture. Unmol did a great lecture. I was away on vacation in Japan, had a great time. I'm refreshed, I'm relaxed, I'm ready to come back and rock and roll. So I hope you guys are doing well. Also, if you like this video, please click the like button. And as always, smash that subscribe button. All right? So I'm Jared Wesley of Live Traders. Let's get to it. All right, this week's lecture topic is win more often. Half the shares, double the stop loss. So this is going to be an interesting one because what I've done here, guys, is I've taken some slides that you guys have seen before. When we talked about the 84% rule, which we're going to talk about briefly today, I used similar slides, and I thought it was kind of interesting and appropriate to do so because it shows how management can vary greatly as well as results, meaning you could take the exact same trades as somebody else and get dramatically different results as somebody else, okay? And that's something I want you guys to think about. You can take the exact same trade, the exact same entry, etc., and so forth, but your results can be completely different. So that's where today's topic comes into play. And I will admit, I think this is helpful for all traders. However, I think this is a little bit more helpful for newer traders, your first year or so of trading, and we'll get into the reasons why as we dig deeper into this. But I think this half the shares, double the stop loss is something that a lot of new traders at some point in their first year should probably try. I'm not saying it's something you'll stick with forever, but it's a very nice way to help get yourself a few more winners, get above that little break-even area, because that first 3, 6, 9, 12 months is one of the most challenging times in your trading career, okay? However, before we get to that, we can't skip when will the insanity stop, right? I mean, this has just become a mainstay, and the truth of the matter is we kind of go up and down with these. Some are like, oh my gosh, and others like, not so bad. This one is kind of in the middle. I had a couple more, but I thought I'd save them for next week. Literally, I just saw this one last night. But again, the insanity, I don't think it's ever going to stop, guys. People are just, like Forrest Gump says, stupid is as stupid does. There's just not a lot of common sense out there these days. We see that in all aspects of life these days. There's just not a lot of common sense. So this one came off of Reddit. Somebody sent this one to me. I did not search this. Somebody sent it to me, and somebody sent me a couple more from Reddit. I blew up my account, and I feel sick to my stomach. Well, you should if you blew up your account. So let's just get to the crux of it. I started out with about $7,000 in September. My Thinkorswim account peaked at a little over $90,000 by April. That's when I slowly started losing hard. So basically, a brand new trader in a 7 to 8 month period made, I don't know, 1,000%, something like that. 7K into 90K. So for those of you that trade with me, you'll know that this scenario would almost be nearly impossible. All right. How and why? Because you shouldn't be risking enough money to make $83,000 in your first 8 months of trading anyway. Your first month or two is likely going to be paper trading, and then after that, very small risk. But we can see why that is, because now this person doesn't have a trading account anymore. They had $7,000, but now they are, fast forward to July, and now I'm down $400. And the past day and weekend, I've been sick mentally. So basically, they started at 7, went to 90, and now they're at minus $400. That is impressive, ladies and gentlemen. I actually feel like throwing up. I want to know how I cope with these losses mentally. Well, just try not to have those kind of losses. And how do we do that? By having stop losses and not risking lots of money, right? Although my initial principle is money I was willing to lose, the idea of kind of getting out of the game and the fact I lost 99, no, you didn't lose 99%. You lost like 101%, right? He said he's down to 400. I apologize. I thought he was minus 400. So he does have $400 left over. I guess what's the difference at that point? Guys, just read these things and take them to heart. I'm not even going to harp that hard on this one. Just look at this. $7,000 to $90,000, and people feel like they're on top of the world. They think they're special. They think they know the markets. Well, obviously, if you allowed 90 to go to $400, you really didn't know shit, did you? Right? You didn't know anything. Meaning your 7 to 90 was just luck. And your 90 back to 400 was probably just as much luck in the opposite direction. You know, we always talk about reversion to the mean. It's a common phrase, meaning when you have a really good week, let's say you have a 90% batting average one week. Well, that can only last for so long. Michael Jordan doesn't shoot 90% every game. He comes back to 50%. So if you shoot 90 one week, how do you get back to 50? By shooting 10 or 20% the next week. That's what happens in trading as well. Okay, here's the thing. You're probably going to bat somewhere between 40 and 60% for most decent traders out there. 50 to 60% is a good range to be in. You just don't know the order in which those losses are going to happen, which means you need a stop loss. Now, I understand, I completely get it, guys, that if you don't use stop losses, you'll probably have an 85 or 90% batting average. But what about the other 10% that don't come back? They blow up your account. They literally destroy your entire account. It's not a matter of if, it's just a matter of when it's going to happen. And this is where most of these come from. If you guys notice, almost every one of these when will the insanity stop lessons are all about what? Risking too much money and or not using a stop loss. So all of you guys out there listening to people are telling you, I use a mental stopper, I don't use stop losses. It just takes one bad trade to take all of your money away. It's typically not a death of 1,000 paper cuts. It's generally 1, 2, or 3 really big losses that wipe out most of your account. And you don't even have to wipe out all of your account to make the climb back up much, 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 much harder. If you lose 50% of your account, you need to make a 100% gain just to get back to break even. Just think about it. So every week I tell you guys the same thing. Money management is your number one job. To win in trading, you first have to last. To win, you first have to last. Okay? All right, let's move on. All right, so this week's topic is mostly charts. You'll be happy about that. But it is a little bit shorter. I'm probably not going to spend a full hour this week. Maybe 30 minutes, 40 minutes. We'll see. This is a nice trade, right? Let's take a look at this chart for a second. We have a wide range igniting bar followed by a narrow range resting bar. Boom, wide range pop, consolidates, pulls back, and then just rips. And this stock ultimately goes from $1.80, $1.90 all the way up to like $4.60, right? That's fantastic. okay? You sit there and you're like, wow, this is beautiful, Jared. This is wonderful. And this is where the marketing pitch comes in. Come follow me and I'll teach you in 27 days how to be the greatest trader ever. And that's how you get those when will the insanity stop editions, because that's what people do. They follow idiots, all right? My point I'm simply making is this is a great pattern, but not all trades do this. In fact, very few trades actually just hit, run, and you don't have any issues whatsoever with them, that they're just perfect, okay? If that was the case, we'd all have 99% batting averages. So while this is a great chart and one you should probably put on your wall and mirror it and try to copy it as frequently and often as possible, the result will not always be the same. Okay, you have the wide bar, you have the narrow bar, it's in the upper 50%. They have relatively equal highs. There's void above, that's great. What are most of you guys doing? One, you're not taking good patterns like this. And when you do, you're finding and looking for, and I see it all the time in the chat room, you're finding and looking for the absolute tightest stop loss you can possibly find. I see it all the time. Yeah, Jared, I took that stock with a 12-cent stop loss. Did you know it had a 9-cent spread? No, I didn't really check the spread. I didn't care. Oh, okay. And then you wonder why when you stop out with nasty slippage, why it hurts so bad. Well, your stop loss is too tight. So that brings me to this. You guys have seen this slide, those of you who have taken professional trading strategies, because, well, it's right out of the book. It's the only slide today that's right out of the book. So what I want to get at, and I said this to you earlier, is this topic, half the shares, double the stop, is good for all traders, but it's especially important for newer traders. See, when you're new, wrongfully so, you only think about the money. You're just thinking, when am I going to be profitable? When am I going to be profitable? When am I going to start making money? Right? And that's not what you should be thinking about. You should be thinking about doing the right thing, proper trading. And most of you, given the choice, will choose. In this case, we have three choices. You will choose the tightest stop possible almost every time. Because in your mind, you think smaller stop, higher risk to reward, higher chance it goes 2 to 1, 3 to 1, 4 to 1, 5 to 1. Right? You're thinking, oh, if I use a 10-cent stop, it's a lot easier for a stock to go 20 cents than it is for the stock to go 40 cents or 80 cents, right? I mean, let's be honest. That's the way you approach it. Because it's a very interesting dichotomy here with traders, right? It's a little almost counterintuitive where before they take the trade, they're always thinking about, gosh, if I use a tight stop, I'll get to my target quick. Or I'll get a bigger target because I have a smaller stop. But the nanosecond they actually get into the trade, the opposite thing happens to them. They start worrying, am I going to stop out? Is this not going to work? What's going to happen? So it's just a very interesting dichotomy. But back to the point is, I want you guys to start thinking about using wider stop losses. So today's topic is about using double the size of a normal stop loss. Don't worry, there's plenty of examples. Okay? So in this area, support and resistance, we talk about this frequently in the chat room and in professional trading strategy. It's not a single penny. It's not. They're areas. Areas, by definition, aren't exact spots. Okay? So when you think about a support area or a pivot on a chart, so say the bottoming tail is $50. That doesn't mean if the stock goes to $49.99 that support has massively been broken and it's never going to bounce again. It just means it went a penny under that bottoming tail. It's still in that area though, right? So this is where the half the stop or twice the stop, double the shares comes in. I want to see you guys starting to use wider stops because they give you more flexibility. I want you to stay away from the least flexibility, greatest risk to reward until you've gained more experience, okay? I want you to choose the most flexible stop, which is the widest stop. Why is this important? Because it allows you to make mistakes. It allows you to not be perfect with your approach, which when you're a newer trader is exactly what you're going to do, is make mistakes. And you're supposed to, and it's okay. So by giving a stock more room, you're not going to stop out as often. Now, you're not going to hit as big of a target, but your batting average is going to improve, and your P&L will likely improve as well. The wider the stop, the more flexibility you have. And it also allows you to what? To add back to the trade later on as well. Or think of the opposite. Let's say the stock, you use a wide stop. In this case, call it 40 cents. In this case, let's say it starts to move in your direction. Now you have the opportunity to raise your stop to a 20-cent stop. Now you only have a half R risk of exposure. Then you can raise your stop to a 10-cent stop. Now you only have what? 1/4 or 25% the exposure, right? So say it starts going in your direction. You can raise that stop off. If you start with the tightest stop, you have a lot less flexibility. Now remember, this is geared a little bit more towards the newer traders because you make a lot of mistakes, right? You don't follow your pre-trade checklist. Maybe you take an aggressive trade, whatever it is, but if you give it more room to wiggle, there's a higher opportunity or likelihood it's going to work. So let's take a look, because this is what most of you are doing, right? You're taking a stop or a stock with a very tight stop loss. You get tagged on it, and then you ultimately watch it go higher and hit your original target, right? And it's crazy frustrating. And you know what this slide is from? The 84% rule slide. It's the exact same slide because the exact same thing happens, okay? You get stopped out, stock goes higher for the rest of the day, and you sit there with your hand in your pants going, I can't believe this is happening. I chose the right stock again, but I didn't make money from it. Is that hitting home with any of you? I chose the right stock again, but I didn't make money from it. It's annoying. It's crazy frustrating. So what can we do about it? Do this. Okay? Do this. Take half the shares, double the stop, but your risk will not change. You're still risking the exact same amount of money. So let's see. You have an entry at $20. Your normal stop loss would be $19.75. Don't worry. There are plenty of charts. I will show you the examples. All right. Let's say a normal stop loss is 25 cents. So a $100 risk would be 400 shares. Well, we're not going to do a normal stop loss. We're going to double it. So instead of using a 25-cent stop loss based exactly on the chart, we're going to take the normal stop loss and double it. So now the new stop loss is $19.50 or double the stop loss. But your risk doesn't change. It's still a $100 risk. The only difference is you take half the shares. So I want that to be very, 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 one more time, very clear. The risk is still $100. The risk is still $100. We're not increasing our risk, okay, or decreasing it. You're just taking half the shares because you're using double the stop. I just want that to be clear. It's a very simple concept. I know I talk slow for a lot of you guys. I do it on purpose because most people are only getting 25% of what I say anyway. All right, so let's take a look at what it would look like on a chart. So here's a great example. 3-bar play on SDC. Wide bar, narrow bar, and it triggers, right? So if you look here, the entry is $9.38. The stop loss is $9.17. That's right out of the textbook. Wide bar followed by a narrow bar. High of the day right here is the entry. The low of bar number 2 is the stop loss. That's right out of the manual. Perfect. You've done nothing wrong. But sometimes they don't work that way. And when you're new, you're not going to take as many of these perfect trades probably, right? You're going to take some trades that have problems because you're new and you miss things. That's normal. It's okay. So entry, $9.38, stop loss, $9.17. In this case, we're risking $500. We need 2,380 shares. The result, minus $500. Why? Because it stopped out, right? It triggered by 3, 4, 5 cents, and then it rolled over, and you stopped out right there on that bottoming tail. Now, judging from this bottoming tail, what do you think happened next? Judging from the bottoming tail, what do you guys think probably happened next? So the stock triggered you in, stopped you out, took your $500, and it rips, right? It rips. So let's take a look at it. Boom. For the entire rest of the day, this thing ripped. There is that area. Stopped out, and then it worked. And this thing went up to $10.75. I mean, that's a big move for a $9 stock. It went like $1.40, give or take. And you just sat there and go, you've got to be effing kidding me. I took a perfect 3-bar play. It stops me out, and then it rips. But what if you had done half the shares, double the stop? What if you gave it a wider stop? So instead of $9.17 is your stop, use $8.96. Why? Well, the stop loss was 21 cents, right? $9.38 was the entry, and it still is the entry. Your stop loss was $9.17. That's 21 cents. Double it. So take 21 more cents off it, and you have $8.96. Your risk is still $500, but now your shares are half, 1,190 shares instead of 2,380 shares. And the result is what? Plus $1,000. So instead of losing 500, you made 1,000. It's a 3R swing. Half the shares, twice the stop. Now, we'll talk about it later because not every single trade goes 4, 5, 6R, but this stock right here went to 1022, which is your 2R target on it. And had you done the original trade, you would have stopped out. Even if you used the 84% rule, you would have only made $500, right? You got to get back your 500 plus the extra 500 you made. In this case, you made 1,000. You actually did better than using the 84% rule, but we'll talk about that in a few minutes, okay? Let's see it again. So here we have what? A 2-minute buy setup on Apple. Take a look to the left, lower high, lower high, lower high, lower high, about a 50% retracement. Some small bottoming tails, and there's a green bar. Well, the entry is 313.40 by 312.60. That's textbook. There's your entry. There's your stop loss. Your target would be right here around 315-ish. Okay? So 313.40, 312.60. Risk is $500. You need 625 shares. What happened? See the little purple line here, the little blue line right here? It triggered right here where my cursor is. Okay, right there. See it? And then an engulfing red bar came in 2 minutes later. Literally, you got stopped out of this trade within the first 2 minutes, 4 minutes. Bounces, pulls back, chops around, pulls back, blah, blah, blah. It's frustrating, isn't it? And then you watch Apple go to 317. You're going, wait a second. Not again. I mean, I had the right entry, but I keep getting stopped out on stocks that work. I'm getting tired of this. So use a wider stop. Use double the stop. So your stop down here is actually below the low of the day at 311.80. You would not have gotten stopped out here. That's right here. If you took the original trade, is exactly where you would have gotten stopped out. But your stop would have held if you used half the shares, double the stop. So 313.40, entry is the same. Stop loss is 80 cents wider. Risk is the same. Share size is half. You only take 312 shares instead of 625. Result, you made $1,000 instead of losing 500. Now, a negative. Well, it took you probably about an hour longer to hit target, right? If we go back to the previous slide, all right, the target is right here around, 10:45-ish, okay? Roughly 10:45 in the morning at 3:15. But if you use the wider stop loss, you didn't hit target until about 11:45. So it took you an extra hour to hit your target. But I think most of you would take waiting an extra hour to make 1,000 versus losing 500. Right? I'll repeat that. I think most of you would gladly wait the extra hour to make 1,000 versus losing 500. It's a $1,500 swing in your account. Okay? So again, we'll try it one more time. So here's another example. Here's a stock that breaks out. Okay, you see this little 1-minute breakout here at $19. Most traders are putting their stop loss here at $19.80 under everything. Okay, it pops up, 18 cents, and then shakes the tree by what? These are the worst. These are the worst. Why? Because it took you out by like 2 or 3 pennies. It literally took you out by like 2 or 3 pennies. And then what did it do? It just went higher and higher and higher. And you're just sitting there like, are you kidding me? And then right at that moment, you're Googling HFT. You're finding out, the 5 biggest HFT firms in the world, and you're putting them on your hit list, right? After you smash your monitor, throw your keyboard, blah, 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 blah. Especially when it happens this quickly. This is a 1-minute chart. You literally get tagged by 2 or 3 pennies, and 4 minutes later, 1 minute, 2 minutes, 3 minutes, 4 minutes, it's back at the high of the day. Tell me this has never happened to you and you haven't cursed the screens. Of course you have. We all have. Okay? But what if? What if you used double the stop? Used 1860 instead of 1880. Well, it didn't go a ton. And granted, this stops at 10:30, 11 o'clock. It may have gone higher. But even if it only makes 1R, it's better than losing 1R. It's still a 2R swing in your trading account. right? So +1 is better than -1. So what I'm getting at is I completely understand here, guys, and we'll talk about it in a few more minutes. I get it. It's harder to hit targets with wider stops because you need more from the stock to get to that target. But you're also going to stop out way less often. Way less often. Okay? So yes, the win-loss ratio is going to go down a little bit, but your batting average is going to go up. And here's the beauty also. The 84% rule still applies. It still applies. Like, what do you mean? Let me explain. Sometimes, even with the wider stop, even with the double stop, you get stopped out. It happens, right? Even with the wider stop. So in this case, you would have gotten in here at 50.10, and your stop loss would normally be where this line is or a little bit lower, right? Kind of where this red bar is, right? And you would have gotten tagged. Now we choose, we're going to give it double the stop. And you might get tagged sometimes. Not as often, but you might still get tagged. Well, 50.60 is the wide stop. It went from a 25-cent stop originally to a 50-cent stop because we're doing double the stop. And then you still get stopped out right up in here. And that sucks. But you can still use the 84% rule even when you do half the shares double the stop. So you'll get back in at 50.10. It bounces, pulls back, and then we got to move up to a 15-minute chart and see, wow, it almost hits full target. So in this case, you would have made about 1.8 R on the re-entry, instead of losing 1 R. So using half the shares double the stop, you will stop out less often, guaranteed. But even if you do stop out, you can still apply the 84% rule. So the first trade you would have lost $500 on, and the second trade you would have made $800 or $900. You still netted +4 versus -5. So it's not like because you're using half the shares twice to stop, the 84% rule doesn't apply anymore. It still applies. You're just going to use it less often because you're going to stop out less often. Okay? So we needed 49.10 for a full 2R target. It went to 49.20. Okay, that's life. All right, let's try it again. Here's another example where on Tesla, and you can see this a little bit older because Tesla's now at $12,000. All right, I'm kidding. But anyway, you have a little sell set up. 528.75, and normally your stop would be like 531.50, give or take, right here. But we're going to use double the stop, 533.50. So now you have a stop loss that's like, I don't know, $4 or $5, give or take, okay? And it gets stopped out. It gets tagged right here. You get stopped out right there. The stock goes up to like 537, 538. Use the 84% rule. Get back in it at 528.75. Use the exact same stop loss, and you hit your full target down here. So what I'm getting at is there's no real big negatives for newer traders to try this. With the understanding that, yes, it will take slightly longer to get to target because they're bigger targets. And also with the understanding, which is mainly the reason you're going to do it, is because you're not great yet. You're going to make mistakes. This allows you more flexibility to make those mistakes and not get hurt as often as you normally would. Okay? So one more example here. All right? Here's another example where you get in at 80 bucks, triggers you're in by a penny. Your normal stop would be somewhere around, 79.85 right here. See it right there under the consolidation, right where my cursor is, right there. And you would have stopped out. If you use double the stop, and I probably should have put a line on this. Let's do that real quick. Where's the line? Let's use this line. Copy. All right, so let's do that. That's where your stop loss will be. Okay. So 79.70 is double the stop right here. And you would have stopped out. Right? 79.70 is double the stop. You would have stopped out. But what if you get back in it? Re-enter at $80. Use the wider stop, 79.70. You need 80.60. Boom, there's your target. So instead of losing 500, you gain 500. Okay, so there's no real negative for newer traders to do this because it just simply gives you more flexibility. And if you do get an opportunity to add to the trade later on, you can do that and still raise your stop. Okay? But as is always the case, we have to throw reality here. Sometimes they just never work. Sometimes you use double the stop, triple the stop, quadruple the stop, and it would never work. Sometimes they just go the other way. We're just wrong. That's rare, but it happens. Why am I throwing this in? So you still take your stop loss, so that I don't have to put you in one of my weekly editions of When Will the Insanity Stop? Understand that you will stop out less often using half the shares, double the stop, but you will occasionally stop out. Anthony, you have not been paying attention. You just said double the risk too. If you have half the shares, how is it double the risk? Please explain. We're all listening. We're curious. Okay. Oh, gotcha. I apologize. Okay. Double the stop, double the shares. That's double the risk. Yes, you're right, Anthony. My apologies. I look like the ass on that one. I deserve it. All right. My point is please, please, please take your stop losses. Whether you use a regular stop, whether it's an 84% rule trade, whether it's half the shares, double the stop, please take your stop loss. That's number one. Okay? So in summary, these are some of the positives and negatives. Using half shares has more flexibility, more margin for error, especially for new traders. You're going to have a higher batting average. Fewer stocks are going to stop out. Okay? It will help build confidence by winning more often. You will have a better batting average. To what percentage? That changes for each trader, but you will have a better batting average. Lower shares means what? Less buying power. A lot of newer traders have smaller accounts, right? So this way, instead of needing, say, 500 shares on a trade, you only need 250 shares. So it costs you less money to take the trade, okay? You can also take more trades because of it, because you're using less money. You have more buying power left over. Okay, you can also, for those people that are always complaining, I can't take high price stocks because I have a small account. You can take slightly higher price stocks now because you're using half the shares, right? And it makes money. Okay, you don't have to say, you're not giving up a lot. Sir, is it as profitable as normal stops? No, but for a new trader, it's more profitable than a normal stop. Because new traders are barely breaking even. They're losing a little bit. They're trying to just claw their way to break even. Half the shares gives you a lot more room to make a mistake and get away with it. Okay, the negatives, you're going to be in trades longer, period. You will, almost definitely. So you're going to need more patience. All right, you're going to need more patience. Fewer trades will hit 2R targets. So you're going to have a lower risk to reward. And more trades, as we go back to the patience, are going to run out towards the end of the day, 330, 345, and you're going to have to close them at the end of the day. That's going to happen. And you're going to have a slightly lower win-loss ratio because fewer trades will hit 2R targets. So instead of having a 1.9 or a 2.0 win-loss ratio, you might have a 1.4. But you're not going to have that 45 or 48 or 50% batting average. You're going to have a 58% or a 60% batting average. It's going to be increased, okay? And done properly, it might not even cost you any money. But to new traders, it's going to make you more money. You're going to be better because your accuracy will be increased because you have more flexibility to make smaller mistakes, right? It's like, I'm trying to think of a good analogy for you guys. It's like shooting a shot from 10 feet in basketball versus 30 feet. It's an easier shot, right? So point is for newer traders especially, there are more positives than negatives, and it's something you should absolutely consider doing because your goal when you're new is not absolute profits. It's not to make the absolute most amount of money possible. It's to learn proper trading, and this gives you the flexibility to do that, okay? So I hope that you guys learned a little bit that will help make you more money, particularly towards the newer traders out there. I think half the shares, double the stop is something that can be very, very profitable for you guys. And it's something I think every new trader should at least try it. Worst case, back test it. Take your last 100 trades and go back and see what would have happened if you had used double the stop on those. Just go back and see what on your last 100 trades, just go back and see what the results would have been. You might surprise yourself. The results might be dramatically better than you think. Okay. Now, as you get more experienced, you're probably not going to use double the stop all the time. You're going to probably use the tighter stop. But when you're newer, that first year or two, it's something you should absolutely consider. All right. Jared Wesley of Live Traders. Hope you guys enjoyed this week's lecture. To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.